A $100,000 salary can make you look a lot richer without making you nearly as financially free as you expected. You get the promotion, the number on the offer letter finally has 6 digits, and you think, okay, money should feel different now. 6 months later, maybe the apartment is nicer, the paycheck is bigger, and your job title sounds more impressive. But somehow, you're still opening your banking app before making a completely normal purchase. So how does a $20,000 raise turn into what feels like only a few $100s of actual breathing room? The first thing to understand is that the raise you see on paper is not the raise you actually experience every month. Imagine someone goes from $80,000 a year to $100,000. On the offer letter, that's a $20,000 jump, which sounds huge. But the money that actually reaches checking is affected by taxes, payroll deductions, benefits, and whatever other deductions apply to that person's situation. So for everyday decisions, the useful number isn't the difference between $80,000 and $100,000. It's the difference between the old monthly take-home pay and the new one. Let's use a completely hypothetical example. Say this person's old take-home pay was about $5,000 a month, and after the raise, it's $6,200. For the way they actually live month to month, the raise is really about $1,200 of additional usable cash. That's still meaningful, but it's very different from mentally walking around thinking, I make $20,000 more now. And that difference matters because a salary milestone changes what can start feeling reasonable. A $400 monthly upgrade might have looked expensive before the promotion. Then the offer letter says $100,000, and suddenly the exact same payment feels like something a six-figure earner should obviously be able to handle. But compare that $400 payment with the actual $1,200 monthly increase, and now you see something different. One decision would claim about 1/3 of the new money. If you like money explained through the numbers that actually affect normal life, that's what this channel is built for. Now here's where the $100,000 trap actually starts. That extra $1,200 arrives as flexible money. It doesn't already belong to rent, a payment, a subscription, or anything else. You can use it for more comfort, more saving, paying something down, taking a trip, keeping more cash available, whatever fits your life. But every time part of that raise becomes a recurring obligation, a piece of that flexibility disappears before next month's paycheck even arrives. Imagine the same person makes a few upgrades after the promotion. Maybe housing costs go up by $350 a month because they move somewhere a little nicer. Transportation costs another $300 more each month. Then $150 gets absorbed by recurring conveniences or services, and another $150 disappears into everyday spending that slowly becomes normal. Nothing here has to be ridiculous. That's exactly why this works. Add those increases together and you get $950 a month. The raise added $1,200 of take-home pay in our hypothetical example, but the upgraded lifestyle added $950 of new monthly costs. So the person's actual increase in monthly flexibility is now about $250. The salary jumped by $20,000 on paper. Their life may look noticeably upgraded, but the amount of extra room they can actually move around with each month barely changed. And that's more interesting than simply saying people spend more when they earn more. Of course they do. Earning more is supposed to improve your life. The problem is not buying something nicer. The problem is making each new decision separately while every decision is quietly competing for the exact same raise. There's also a major difference between spending $300 once and committing to another $300 every month. The one-time purchase costs $300 and then it's over. A $300 monthly obligation changes next month's starting line, then the month after that, then the month after that. Recurring costs don't just spend today's money, they put their name on future paychecks. And once enough of those commitments stack up, something subtle happens. Your minimum cost of maintaining your current life moves higher. You may still technically be earning much more than before, but now more of that income arrives already spoken for. The raise gave you more money, then the new lifestyle gave more of that money a permanent job. This is also where the question in your head can quietly change. Before the raise, you might ask, can I afford this? After hitting a number like $100,000, the question can become, Shouldn't someone making six figures be able to afford this? Those sound almost identical, but they're not. The second question uses your salary as permission to buy something instead of evaluating what that purchase actually does to your cash flow. Take a $300 monthly payment. Against a $100,000 salary, $300 can sound almost trivial. Against a hypothetical $1,200 increase in monthly take home pay, it's 25% of the entire improvement. Same payment, same person, completely different way of seeing the decision. And the biggest consequence isn't even that you might save less. It's that two people can earn the exact same salary and have completely different amounts of freedom. Imagine two people both make $100,000. One needs almost every paycheck to maintain the life built around that salary. The other has much more room between what comes in and what has to go out every month. Their income looks identical on LinkedIn. Their ability to handle change is not. You notice that difference when life stops following the plan. Maybe an expensive repair shows up. Maybe you want to take some time off. Maybe you want to move. Maybe the job is becoming miserable and you'd like the option to leave without immediately panicking about every bill attached to your current lifestyle. That's when the gap between income and obligations stops being an abstract financial concept and starts becoming actual leverage over your own life. This is the part of the six-figure salary trap that almost never gets advertised with the promotion. A higher salary can make your job more valuable to you at exactly the same time that your upgraded expenses make losing that salary more dangerous. The job isn't just supporting your old life anymore. It's supporting the entire cost structure that grew around the new income. So the salary gave you more money, but the obligations can make you more dependent on keeping the salary. That's a strange trade. You can look wealthier while becoming more financially locked in. The useful thing is that you can actually measure this without building some giant spreadsheet that makes you question every grocery receipt from the last 6 months. Go back to the last meaningful raise you received. Find what your average monthly take-home pay looked like before it, then compare that with what actually lands in your account now. The difference is the first number you care about. Then look only at the recurring expenses that appeared or increased after the income jump, not your entire budget. Maybe housing changed, maybe transportation changed, maybe there are services or convenience expenses you didn't really use before. Write down the monthly increase for each one and total them. Then subtract that number from the increase in take-home pay. If take-home increased by $1,200 and recurring costs increased by $950, the result is $250. In this example, that's the amount by which monthly flexibility actually improved, not the salary headline, not the impressive annual number, the part of the raise that survived. There's one more question that makes this calculation much more useful. If your income changed tomorrow, how quickly could you undo each new expense? Some recurring costs are easy to cut. Others are attached to leases, financing agreements, or arrangements that may take much longer to change. Two expenses can cost the same $300 a month and create very different levels of commitment. That doesn't mean harder to reverse expenses are automatically bad decisions. A nicer apartment might be worth every dollar to you. A more expensive transportation setup might solve a real problem. Paying for convenience during an exhausting period might give you back time you genuinely value. The point isn't to eliminate every upgrade. The point is to know what you're trading flexibility for before that trade becomes invisible. And this gives you a better way to evaluate the next raise too. Suppose your take-home pay eventually increases by another hypothetical $1,000 a month, and you're considering a new recurring payment of $250. Instead of saying, I make $100,000, $250 is nothing, compare the payment with the actual increase that reached your account. Now you're looking at a decision that claims 25% of the improvement created by the raise. Maybe that's completely worth it. Maybe it's not. Leon doesn't need to make that decision for you because now you can actually see the trade-off. That's the real $100,000 salary trap. It's not earning $100,000, it's not paying taxes, and it's definitely not the idea that you're never allowed to enjoy making more money. The trap is letting the number on your offer letter raise the permanent cost of your life almost as fast as it raises your income. A six-figure salary can upgrade your lifestyle faster than it upgrades your freedom. So the next time your income moves up, don't only ask, how much more do I make? Ask, how much more actually reaches me? How much of that became a recurring obligation? And how difficult would those commitments be to reverse? Your salary tells you what you earn. The gap between your income and your obligations tells you how much room you have to move. Because the goal isn't just a bigger number on a paycheck, it's more control, more stability, and more options. And if that's how you want money explained, subscribe.